Every trader enters the market believing the real secret lies somewhere outside, inside a strategy, an indicator, or a hidden pattern that only the elite seem to understand. But the truth is far more uncomfortable and far more empowering. The market doesn't decide your success. You do. Profitability is not a function of predicting price. It is a function of mastering yourself, your reactions, and the meaning you attach to every tick. The markets offer endless opportunities, but only to the trader who has learned to stop fighting the uncertainty and instead work with it as a willing partner. Most traders fail because they're trapped in a cycle of emotional conflict. They want to win, but they fear losing. They want freedom, but they crave control. They believe they're thinking objectively, yet their decisions are shaped by past pain, expectations, and the illusion that the market owes them something. A profitable trader isn't someone who knows the future. A profitable trader is someone who no longer needs to know it, to act with confidence and consistency. That is the secret most people overlook. Real trading success begins when you accept that every moment in the market is unique. No trade has to behave like the last one, and no outcome is ever guaranteed. The traders who understand this deeply stop forcing the market to fit their expectations. Instead, they flow with whatever the market is offering. They act without hesitation, without fear, and without the psychological baggage that distorts perception. Their edge is not the strategy itself, but the mindset that allows them to execute it flawlessly. The real transformation starts when you stop measuring your value by whether a trade wins or loses. Losses stop feeling personal. Wins stop feeling like proof. The emotional roller coaster fades because you're no longer negotiating with the market. You're following a process that aligns with the unchanging truth of probabilities. When you finally trust that edge, a calm confidence replaces the frantic need to be right. You stop chasing trades. You stop forcing outcomes. You stop reacting to the market and start responding to it. Once you understand that the market reflects nothing but opportunity, your entire experience changes. You begin to see clarity where others see chaos. You begin to make decisions that are effortless because there's no internal conflict pulling you in opposite directions. The hesitation that once cost you profits dissolves, replaced by a quiet certainty that allows you to take the next trade and the next and the next without emotional resistance. That is the mindset of consistency. That is the mindset of a profitable trader. And the secret behind it all is simple. Mastery does not come from controlling the market, but from controlling the meaning you attach to it. When the fear, the hope, the pressure, and the need to be right are no longer dictating your behavior, you unlock a level of freedom that most traders never reach. That freedom is the beginning of true profitability. Mastering your mindset before mastering any strategy is the foundation on which all consistent trading success is built, yet it's the element most traders overlook because it doesn't appear as concrete or measurable as a system, an indicator, or a chart pattern. When traders first step into the markets, they instinctively search for external tools, something mechanical that promises certainty and control. They believe profitability is directly tied to finding the right setup, the perfect entry technique, or the most accurate prediction model. But the longer they trade, the more they discover that even the best strategies fail in the hands of someone who hasn't gained command over their internal environment. The market exposes every psychological weakness: hesitation, fear, greed, impulsiveness, the need to be right, the need to avoid loss, the fear of missing out, and the pressure to prove something. Without mastering your mindset, each of these forces becomes an invisible hand interfering with your decisions, shaping your perception, and ultimately dictating your results. A trader with an untrained mindset doesn't see the market as it is, but as a reflection of their fears and desires. When you're emotionally attached to outcomes, the chart is no longer just price movement, it becomes a mirror, reflecting your hopes or confirming your worries. A losing trade becomes a personal attack, a winning trade becomes validation. This emotional distortion is what leads traders to override their plan, break rules, get out too early, hold too long, or take trades that have no real edge. The chart hasn't changed, your state of mind has. And until you gain awareness of this dynamic, every strategy you attempt will eventually fall apart under the weight of your own emotional conflicts. Mastering your mindset starts with understanding that the market is neutral. It has no intentions, no awareness of you, no memory of your past wins or losses. It doesn't punish, reward, favor, or discriminate. It simply presents opportunities. The meaning you attach to those opportunities comes entirely from within you. If you carry fear, every movement looks dangerous. If you crave certainty, every fluctuation becomes a threat. If you associate losses with personal failure, you'll find yourself avoiding trades that fit your plan. When your beliefs and emotions color the way you interpret market information, you're no longer making objective decisions. You're reacting to internal pressure rather than responding to external reality. This is the single biggest barrier to consistent trading. To master your mindset, you must create psychological distance between your identity and your trade outcomes. Many traders subconsciously tie their self-worth to winning trades and view losses as evidence that they're not skilled, not smart, or not capable. This creates a mental environment where every trade becomes emotionally loaded. Instead of focusing on probabilities, you end up defending your ego. You hesitate because you don't want to be wrong. You let losses run because admitting the trade failed feels like admitting you failed. You exit winners too early because you fear losing the profit you've already attached emotional value to. All of these behaviors stem from the same core issue. You haven't separated your identity from the random distribution of trade outcomes. True mindset mastery begins when you accept that losing trades are not mistakes. They are simply part of the game. When losses no longer feel threatening, you stop avoiding them and start managing them with clarity and precision. You start following your rules because your rules are no longer in conflict with your emotional needs. You start executing your strategy consistently because you're no longer filtering the market through fear or hope. This psychological freedom is what allows traders to finally give their edge the chance to play out. Another crucial aspect of mindset mastery is learning to remain present. Most traders operate either in the past or in the future. They replay past mistakes, past losses, or past wins, and allow those memories to influence what they see right now, or they project imagined outcomes into the future, dreaming about potential profits or worrying about potential losses. This pulls them away from acting in alignment with the actual information the market is giving in the moment. Staying present means recognizing that the only thing you have control over is your next decision. You can't control how the market will move. You can't control the outcome of any trade. But you can control how accurately you execute your edge. And that level of focus can only be reached when your mind is not clouded by emotional baggage tied to past or future expectations. A well-trained mindset also understands probability at a deep experiential level, not just intellectually. Many traders can repeat phrases like anything can happen or losses are part of the game, but emotionally they still resist uncertainty. They still react as if each trade should behave a certain way. They still feel upset when the market doesn't do what they expect. Mastering probability means internalizing the idea that each trade is independent, unique, and unpredictable. When you stop needing the market to fulfill your expectations, your mind becomes quiet. You stop arguing with the chart. You stop fighting its movement. You begin to flow with the market instead of resisting it. This shift alone transforms your ability to take high-quality trades without hesitation. Mindset mastery also requires developing the ability to observe your internal dialogue without letting it dictate your actions. Most traders operate on autopilot, allowing fear-based thoughts or impulsive urges to hijack their trading decisions. When you cultivate awareness, you can recognize these emotional impulses as they arise. You can see fear telling you to avoid a trade that fits your plan. You can see greed urging you to chase a setup that doesn't meet your criteria. You can see impatience pushing you to enter too early or exit too late. By observing these internal reactions instead of obeying them, you gain control over your behavior. And once your behavior aligns with your rules, consistency becomes possible. Another element of mindset mastery is recognizing that the market rewards discipline, neutrality, and patience, not emotional intensity. Many traders come into the market with a performance-driven mentality, trying to force results through effort, willpower, or aggression, but the market doesn't respond to effort, it responds to decisions. No amount of intensity can compensate for emotional instability. The calmer your internal state, the clearer your perception. The clearer your perception, the better your decisions. The better your decisions, the more consistently your edge expresses itself. Mastering your mindset is not a one-time achievement. It's an ongoing process of self-observation, emotional awareness, and continuous refinement. It requires honesty with yourself, the willingness to confront your own mental patterns, and the discipline to reshape them. The strategies you use matter, but your mindset determines whether you can execute them reliably across hundreds of trades. Without mindset mastery, even the strongest edge becomes inconsistent. With it, even a simple strategy can become powerful because you're able to apply it with stability, objectivity, and confidence grounded not in prediction, but in discipline and psychological alignment with the nature of the market. Every trade outcome is unique, and accepting this truth at a deep emotional level is one of the greatest breakthroughs a trader can experience. Most traders say they understand uncertainty, but their behavior tells a different story. They still expect the market to behave consistently. They still assume that a familiar pattern should produce a familiar result. They still react as if the market owes them predictability simply because the setup they see has worked before. This subtle expectation creates a psychological trap where traders unconsciously demand certainty from a system that was never designed to provide it. When you believe a trade should work because it looks like a previous winner, you begin to attach emotional significance to the outcome. This emotional attachment becomes the source of stress, hesitation, and impulsive behavior. What you perceive on the chart becomes filtered through what you hope or fear will happen, not what is actually happening. Each moment in the market is formed by countless variables: economic conditions, liquidity, algorithms, human emotions, institutional actions, and global events interacting at once. No two moments can ever replicate themselves perfectly, even if the chart pattern appears identical. The illusion of similarity leads traders to form expectations based on past experiences, but the market does not repeat, it only rhymes. This means that a trade setup that worked yesterday can fail today, and a setup that failed last week can become a major winner tomorrow. When you internalize the uniqueness of each market moment, you stop projecting assumptions onto the price action. You begin to observe more clearly, respond more objectively, and make decisions without the emotional interference that comes from expecting a specific outcome. Understanding the uniqueness of each trade outcome also frees you from the burden of needing to be right. Traders who cling to the idea that the market should behave in a certain way experience frustration when it doesn't. This frustration leads to a roller coaster of emotions. You may feel confident when the market aligns with your expectations and then crushed when it diverges. This constant shift between hope and anxiety creates inconsistency in execution. When you eliminate the belief that the market owes you a specific result, your entire trading mindset shifts. You stop trying to predict and you start managing probabilities. The pressure to be right dissolves, and with it, many of the emotional triggers that lead to reckless decisions. Another important aspect of accepting the uniqueness of each trade is learning to detach from patterns you have seen before. A chart pattern does not cause price to move. It only reflects what has already happened. Many traders treat patterns as guarantees rather than possibilities. They expect the same outcome because the pattern resembles one that led to a profit in the past. But every trader participating in the current market is reacting to information in real time, and their collective behaviors produce a unique result each time. When you cling to past outcomes, you blind yourself to the present moment. This leads to forcing trades, entering too early, exiting too soon, or ignoring new information because it conflicts with your expectations. Embracing the uniqueness of each trade outcome also changes the way you interpret losses. When you believe that a setup should work, a losing trade feels like a personal failure or a betrayal of trust. You question your system, your judgment, your abilities. But when you understand that no pattern guarantees anything, losses become neutral events. They are simply one expression of the market's infinite variability. This neutrality is essential for developing resilience. A trader who reacts emotionally to losses becomes hesitant, reactive, and inconsistent. A trader who sees losses as a natural outcome of probability remains focused, calm, and disciplined. This mental freedom allows you to take the next trade without fear or hesitation. Accepting uniqueness also sharpens your ability to read the present moment. When you are no longer comparing the current setup to past experiences, you begin to notice subtle details you previously ignored. You become more attuned to changes in volatility, momentum shifts, liquidity behavior, and the rhythm of price movement. You stop trading what you want to see and start trading what is actually in front of you. This level of presence is one of the most powerful psychological edges a trader can develop. When you approach every trade as a brand new event, unconnected to anything that came before it, your decisions become cleaner and more precise. The uniqueness of each trade also reinforces the importance of having a clear strategy, grounded in statistical probability. Since no individual trade can guarantee an outcome, your edge only reveals itself over a series of trades. This is where many traders struggle. They judge their strategy based on one or two outcomes rather than a large sample size. They overreact to a losing trade and change their system prematurely, or they become overly confident after a winning streak and start taking reckless risks. When you deeply internalize that each trade is independent, you stop overvaluing individual outcomes. You begin to trust your edge across many trades rather than needing every single trade to work. This mindset also protects you from emotional extremes. When you expect the market to repeat itself, a winning trade can lead to overconfidence. You start increasing your size, taking lower quality setups, or abandoning risk management because you expect the market to continue rewarding you. When you accept that each outcome is unique, every trade remains just one data point. You stop inflating the importance of wins and stop dramatizing losses. This emotional stability leads to consistency, a trait that separates professional traders from amateurs. Recognizing the uniqueness of each trade outcome also helps you break free from cognitive biases. Confirmation bias is one of the most common traps. When you expect a pattern to behave like it did before, you look for evidence that supports your expectation and ignore signals that contradict it. This selective perception narrows your awareness and prevents you from seeing danger early. But when you approach the market without expectation, you observe more neutrally. You allow new information to guide your decisions rather than seeking out reasons to confirm what you want to believe. Another bias reduced by accepting uniqueness is recency bias, the tendency to assume that recent outcomes will continue. After a string of wins, you may feel invincible. After a string of losses, you may feel doomed. But each trade remains independent. The market doesn't know or care about your last 10 trades. When you understand this fully, you stop letting your emotional state drift with short-term results. You remain grounded in your process. Finally, embracing the uniqueness of each trade outcome brings a profound sense of psychological freedom. You stop trying to control the uncontrollable. You stop resisting uncertainty. You stop comparing the past to the present. You approach each trade with a clear mind, free from the weight of expectation. This clarity allows you to execute your edge with consistency, calmness, and confidence, rooted not in prediction, but in an intimate understanding of how the market truly works. Consistency comes from process, not predictions, and this single realization reshapes everything about the way a trader approaches the market. Most traders spend their energy trying to forecast what will happen next, where a price will go, when it will reverse, how far it will move, and whether the setup they see will deliver a win. This constant focus on prediction is rooted in the desire for certainty, and the desire for certainty is rooted in fear. Fear of loss, fear of being wrong, fear of missed opportunities. The irony is that the harder a trader tries to predict, the more emotionally attached they become to the outcome, and the more inconsistent their execution becomes. Process, on the other hand, is grounded in discipline, structure, and repeatable behavior. It shifts the source of confidence from what the market might do to how you will respond, and this is where true consistency is born. A prediction-based mindset is fragile. It thrives only when the market aligns with your expectations. When the market behaves differently, as it often does, the trader becomes confused, frustrated, and reactive. This emotional turbulence leads to impulsive decisions, chasing trades, exiting too early, holding too long, or abandoning a strategy after only a few losses. In contrast, a process-based trader understands that the goal is not to be right on each trade, but to execute an edge over many trades. They accept the natural distribution of wins and losses. They recognize that randomness plays a role in every single outcome, yet over time, probabilities work in their favor only if they follow their rules with precision. Process becomes the stabilizing force that keeps emotions from derailing performance. A clear and well-defined process includes several components: identifying an edge, waiting for the setup, managing risk, executing entries, managing trade progression, and closing positions based on predetermined rules. Each piece has its purpose, and when followed consistently, the trader can operate with confidence regardless of whether the next trade results in a win or loss. When your confidence comes from your method instead of your predictions, you stop seeking reassurance from the market. You stop needing the chart to confirm your hopes. You stop micromanaging every fluctuation in price. You begin to trust the system you've chosen and your ability to follow it consistently. One of the most powerful shifts that occurs when you embrace process over prediction is the removal of emotional noise from decision-making. When you are trying to predict, every movement feels personal. Every small fluctuation seems meaningful. Every candle becomes a source of tension. Your mind becomes hyperactive, analyzing possibilities that have no real relevance to your plan. But when you rely on process, your attention narrows to what actually matters. Does the setup meet the criteria? Does the risk fit the plan? Does the trade align with the edge? If not, there is nothing to do. This structure eliminates the chaotic thinking that leads to overtrading and emotional decisions. Another benefit of process-driven trading is the development of emotional neutrality. When predictions fail, the trader feels wrong, embarrassed, or disappointed. When predictions succeed, the trader feels validated, excited, and sometimes overconfident. Both emotional extremes are dangerous because they distort perception and interfere with objective decision-making. Process removes this emotional roller coaster. Wins feel normal, losses feel normal, and neither outcome influences the next trade. You become less attached to the outcome and more committed to the execution. Emotional neutrality is what allows you to stay calm through losing streaks and focus through winning streaks. Consistency through process also creates long-term resilience. Traders who rely on predictions often fall apart after a few unexpected losses. They question their strategy, change indicators, switch timeframes, or abandon their plan entirely. They chase the illusion of a perfect system that will align with their predictions every time. This cycle repeats endlessly because no system can eliminate randomness or guarantee outcomes. Process-driven traders understand that losses are part of the game. They don't panic when the market behaves unexpectedly. They don't search for new strategies after a losing streak. Instead, they review their execution, evaluate whether they followed their rules, and continue applying the same edge with discipline. This resilience builds confidence through experience. A process-based mindset is also what allows traders to handle uncertainty with composure. Prediction-oriented traders try to avoid uncertainty by seeking signals that confirm their expectations. They wait for extra confirmation, hesitate on entries, or get out early because they are afraid of losing their unrealized profits. But uncertainty cannot be eliminated, only managed. Process gives you a framework for dealing with it. You know how much you risk before entering the trade. You know how you will manage your stop. You know when to exit, whether the trade moves in your favor or not. These predefined rules remove ambiguity and reduce hesitation, allowing you to act decisively instead of emotionally. Process also reinforces the understanding that trading is not about any single trade, but about a long series of trades. When traders rely on prediction, they treat each trade as if it holds massive significance. They obsess over whether it will win or lose. This magnification of a single outcome creates pressure, and pressure leads to errors. A process-driven trader sees each trade for what it is, one event within a much larger sequence. The importance is placed not on predicting the outcome of that event, but on executing the edge consistently across many events. This shift in perspective removes pressure and allows the trader to operate with a calm, steady mindset. Moreover, a process-based approach provides clarity during volatile market conditions. When the market becomes unpredictable, traders focused on prediction often freeze or become reckless. They are overwhelmed because the behavior does not match their expectations. But for a trader grounded in process, volatility does not alter their approach. The rules remain the same. The conditions either meet the criteria or they don't. This consistency in action creates consistent results over time. Process-driven trading also builds a strong sense of self-trust. When you learn to execute your rules regardless of emotional impulses, you begin to trust yourself deeply. You stop second-guessing. You stop hesitating. You stop feeling uncertain about your decisions. This internal confidence is far more powerful than any indicator or market analysis. When you trust yourself to follow your process, you no longer need the market to reassure you. This inner stability is what allows traders to reach the level of consistent performance that others struggle to achieve. Finally, focusing on process shifts the trader from a reactive mindset to a proactive one. Reactive traders respond emotionally to what the market does. They make decisions based on fear or desire. Their behavior is shaped by external forces. Proactive traders, grounded in process, act according to their plan regardless of what the market throws at them. Their actions are deliberate, structured, and aligned with a long-term edge. This proactive approach is what transforms inconsistency into consistency, confusion into clarity, and emotional trading into professional execution. Detaching emotionally from wins and losses is one of the most transformative psychological shifts a trader can make, because the market has a unique way of amplifying emotions and reflecting them back through your decisions. Most traders enter the market with a strong attachment to outcomes. A winning trade gives them excitement, confidence, and a sense of validation. while a losing trade brings frustration, disappointment, self-doubt, and even fear. These intense emotional swings create instability in execution, because decisions stop being based on logic and process and instead become reactions to emotional highs and lows. When you attach your self-worth or sense of competence to the outcome of individual trades, you give the market power over your inner state. You lose objectivity. You lose clarity. And without clarity, consistent trading becomes impossible. Every win feels like proof that you're a skilled trader, and every loss feels like a statement about your inadequacy. This creates enormous pressure during every trading decision because you're not just risking money. You're risking your emotional identity. Your ego becomes intertwined with the outcome. You hesitate because you don't want to be wrong. You hold losers because taking the loss feels like admitting failure. You exit winners too early because you fear giving back what you've already mentally claimed as yours. These behaviors are not failures of strategy, they are failures of emotional management that come from attaching meaning to the outcome of a single trade. Detaching emotionally means recognizing that wins and losses are not personal. They do not define your intelligence, your talent, or your future as a trader. They are simply the natural expressions of probabilistic outcomes in an uncertain environment. When you internalize this, the emotional weight you place on each trade begins to dissolve. You no longer see a loss as a threat. You no longer see a win as proof. You stop evaluating yourself through the lens of short-term results and start focusing on your execution. This shift frees your mind from emotional turbulence and restores objectivity in decision-making. Emotional detachment also means understanding that a single trade is irrelevant in the grand scheme of your long-term edge. Whether the next trade wins or loses makes no difference if you are executing consistently over hundreds of trades. Professional traders understand that their job is not to win every trade, but to allow the law of large numbers to work in their favor. When you embrace this philosophy, you stop obsessing over individual outcomes. You stop reacting emotionally to normal market fluctuations. You begin to see each trade as just one data point in a large series. And this perspective removes the emotional intensity that often leads to self-sabotage. Another aspect of detaching emotionally is redefining what a win and a loss means. Most traders view a winning trade as good and a losing trade as bad, but this simplistic view ignores the complexity of trading behavior. A winning trade taken outside your rules is not a good trade. It's a dangerous reinforcement of bad habits. A losing trade executed perfectly according to your plan is not a bad trade. It's a successful execution of your process in a market that delivered one of its natural outcomes. When you detach emotionally, you judge your performance by how well you follow your rules, not by whether the market rewarded you with a profit. This internal shift allows you to cultivate discipline, because discipline becomes more important than outcome. Emotional detachment also influences your ability to manage risk correctly. Traders who are emotionally tied to outcomes often risk too much because they want the win to mean something. They double their size after a win out of excitement or after a loss out of desperation. They abandon risk management because their emotions dominate their logic. But when you detach emotionally, you stop using the market as a way to satisfy emotional needs. You respect your risk parameters because you understand that your edge only works when risk is controlled. You take the same size, follow the same rules, and manage trades with consistency regardless of how you feel. Another powerful benefit of emotional detachment is the elimination of fear-based decision-making. Fear is one of the strongest forces that distort perception. Fear causes traders to avoid taking trades that fit their plan, exit positions prematurely, or hesitate at key moments. But fear is directly tied to the emotional meaning attached to outcomes. When a loss feels threatening, fear arises. When being wrong feels unacceptable, fear arises. When the future feels uncertain, fear arises. Once you detach emotionally from the outcome, fear loses its grip. A loss becomes just a loss, not a judgment. Being wrong becomes normal, not shameful. The future becomes uncertain, but uncertainty is no longer frightening because it's no longer tied to emotional stakes. Detaching emotionally also enhances your ability to remain patient. Emotional traders often overtrade because every small movement triggers excitement or anxiety. They feel compelled to act because their emotions demand engagement with the market. But when you detach emotionally, you no longer need the market to satisfy any emotional need. You can sit, wait, observe, and strike only when your setup appears. Patience becomes natural because you are no longer driven by the internal pressure to escape discomfort or chase excitement. This calmness is what allows traders to consistently choose higher quality setups rather than reacting impulsively to market noise. A detached mindset also supports resilience after losses. Emotional traders spiral into frustration or revenge trading after a losing streak. They increase their size, take random trades, or abandon their systems because they feel pressured to win back what they lost. Detached traders do not fall into this trap because losses do not trigger emotional panic. They approach losing streaks analytically, checking if they followed their rules, reviewing their risk, understanding whether the losses were normal variance or execution errors. This analytical mindset prevents emotional cascades and preserves account equity. Detachment also prevents euphoria after wins. Many traders underestimate how dangerous winning streaks can be. Wins create overconfidence. Overconfidence leads to risk-taking beyond the plan. Emotional attachment to winning can make traders forget the possibility of loss and believe they have a special insight or control over the market. This false confidence is usually followed by a sharp drawdown. Detachment keeps the trader grounded. A win is simply an outcome produced by following the process. Nothing more, nothing less. There is no ego boost, no inflated belief in personal superiority, and no behavioral shift. This stability is what allows traders to maintain consistent performance across all market conditions. Finally, emotional detachment allows the trader to experience true clarity. When you are no longer clouded by fear, hope, excitement, anger, greed, or frustration, the market becomes easier to read. You see what is actually happening instead of what you want to happen. You interpret price action objectively. You make decisions without internal conflict. You execute your edge with stability because your mind is not fighting itself. Emotional detachment is not about being numb or robotic. It is about understanding that your emotions have no place in determining your trading decisions. The market is neutral, and when you adopt that same neutrality, your actions become aligned with the realities of probability, discipline, and long-term success. Confidence grows from trusting your edge, not needing to be right. And this distinction is what separates traders who thrive from those who remain trapped in cycles of frustration, self-doubt, and inconsistency. Many traders mistakenly believe that confidence comes from winning. They think confidence is built when the market proves them right over and over. But this creates a fragile foundation because the moment the inevitable losses appear, that confidence collapses. Confidence based on being right is temporary, unstable, and emotionally dependent on outcomes you cannot control. True confidence comes from something deeper. Your trust in your edge, your method, and your ability to execute your plan regardless of what the next trade brings. When your confidence depends on accuracy, every trade becomes a test of your worth. You hesitate because you fear being wrong. You hold losers hoping to avoid admitting a mistake. You exit winners too early because you want to lock in the feeling of being right. Your entire trading experience becomes centered on protecting your ego instead of following your process. This attachment to correctness distorts how you see the market. Instead of observing objectively, you look for evidence that validates your predictions. Instead of responding to changing conditions, you cling to biased expectations. This mindset traps traders and prevents them from developing the steady composure required for long-term success. True confidence emerges when you fully understand that being right on any single trade means nothing in the context of probability. An edge works over a series of trades, not each individual one. The best traders in the world are wrong frequently, yet they remain confident because their trust is not placed in the outcome of one trade, but in the statistical reliability of their method. When you internalize this truth, your approach to trading changes. You stop obsessing over individual outcomes and start focusing on consistent execution. You stop reacting emotionally to wins and losses and begin seeing them simply as part of the distribution of your edge. Trusting your edge means knowing exactly what your system is designed to do, what conditions it performs well in, what conditions it struggles in, and what the average outcome looks like over time. It means understanding the risk you take on each trade and accepting it without internal conflict. It means knowing that losses are not failures. They are expected costs of trading built into your probability model. This understanding frees you from the emotional tension that comes from needing every trade to work. When you trust your edge, you no longer need constant reassurance from the market. You don't need to predict. You don't need to force trades. You don't need to chase missed opportunities. Your confidence comes from your ability to stick to your plan, to follow your rules, and to manage your behavior. This inner stability allows you to act decisively, even in uncertain market conditions. You don't freeze because of fear. You don't overreact because of excitement. Your actions become grounded, deliberate, and consistent. Confidence built on trust also strengthens your ability to handle losing streaks. Traders who rely on being right unravel quickly when they hit a series of losses. They panic, doubt their strategy, experiment with new indicators, switch timeframes, or abandon their edge entirely. This behavior damages consistency and prevents the edge from ever having the chance to play out. A trader who trusts their edge remains calm during losing streaks because they understand that losses cluster just as wins do. They evaluate whether they executed properly, adjust if necessary, and continue forward without emotional turmoil. This resilience is a defining trait of professional traders. Trusting your edge also helps you avoid the trap of overconfidence after a winning streak. Winning does not make the edge more reliable, it simply reflects the statistical side of the distribution. When traders confuse winning with being right, they increase position size impulsively, break their rules, and start believing they've mastered the market. This almost always leads to sharp losses. But when confidence comes from trust rather than ego, winning streaks do not change your behavior. You follow the same rules, maintain the same discipline, and treat each new trade objectively. Your psychological state remains stable because your identity is not tied to outcomes but to your process. A major part of trusting your edge is learning to separate your emotions from your decisions. When you believe your confidence comes from being right, you become emotionally invested in the outcome. You feel pressure, you feel fear, you feel excitement or panic. But when your confidence comes from your edge, your emotional energy is no longer tied to the outcome. Your sense of stability remains intact through ups and downs. This emotional neutrality enables clarity, allowing you to read the market without internal noise. You become more aware of subtle signals, more patient in waiting for your setup, and more disciplined in managing your risk. Another benefit of trusting your edge is the reduction of internal conflict. Traders who need to be right fight themselves constantly. Their mind is split between what the chart shows and what they want it to show. This internal battle creates hesitation, second-guessing, and rushed decisions. But when you trust your edge, your mind aligns with your plan. There is no conflict between emotion and logic. Decisions become cleaner. Execution becomes smoother. Confidence becomes natural rather than forced. Trust also strengthens discipline. When you know what your edge can produce over time, you are motivated to follow your rules because you understand the long-term payoff. You no longer feel tempted to deviate from your system. You no longer feel the urge to jump into random trades. Your actions reflect a deeper commitment to the process rather than a desperate attempt to be right. Discipline becomes a natural extension of your confidence. Furthermore, trusting your edge enhances your ability to adapt without emotional panic. If you notice your edge is deteriorating due to changing market conditions, you approach the adjustment analytically. You evaluate data, study behavior, and refine your process. You don't rush to change everything after a few losses. You don't cling to outdated beliefs out of fear. Your confidence allows you to explore improvements with a calm and curious mindset rather than avoiding change because it threatens your sense of certainty. Finally, confidence rooted in trust creates a long-term vision. You stop seeing trading as a series of emotional battles and start seeing it as a strategic, probabilistic endeavor. Your mindset becomes aligned with growth, skill, and mastery rather than short-term gratification. You understand that the journey is continuous and the edge is something you nurture, study, and execute, not something you gamble on. This long-term perspective is what allows professional traders to maintain consistency year after year, regardless of market cycles, volatility shifts, or emotional challenges.